Hello, Kevin Murphy from Schroders. Can you explain us a bit about your value investing strategy?
Sure. So I'm the co-manager of the Schroder Recovery Fund, is my flagship portfolio that has been in existence in 1970. So it's 50 next year. There's very few retail funds in the UK marketplace that have a 50-year track record. And the track record of the portfolio is something that we're very, very proud of. So we're not the first managers of the portfolio. I didn't start managing in 1970, but I did take over in 2006. And the long-term track record is exceptional. So it's outperformed the market by about 400 basis points per annum, and since we've taken over it, we've managed to maintain that level of outperformance since 2006, and it's something that we're very proud of.
And what caused your great outperformance over the past years?
So basically doing what other people either don't, won't or can't. So it's investing in areas of the market that other people are scared of. It's by going and buying the deep value opportunities. It's by doing a lot of hard work on those and making sure we buy the ones where we think the long-term prospects are good and where people, their risks are overstated. And by doing that in a diversified portfolio has over time built us up to a wonderful track record.
How many stocks are on average in your portfolio?
So it's we say between 30 and 50 stocks. At the minute it's about mid-30s. It's been higher than that. So in 2009, for example, we were up at 70 stocks as the opportunity set was so broad. Today the opportunity set is much narrower, so the number of holdings in the portfolio has concentrated down and we're about mid-30s.
And do you also invest in micro stocks or microcap stocks or small caps?
So for the recovery fund, we do. So we run a number of funds on the desk, but for the recovery fund, we're buying into companies that have fallen on hard times. And it's very unlikely when you've got a company that's fallen by, say, 75%, that it's still in the FTSE 100. So we have to have the opportunity and the flexibility to go up and down the market cap spectrum. So we do look at small cap companies. We look at companies that are going through significant financial issues that may need a rights issue, for example. And you tend to find those at the smaller end of the market. So we're very hard and maintain capacity controls to ensure that we can continue to go down to the microcaps, but about £100 million is where we cut off.
What are your major differences with, for example, Warren Buffett's strategies?
Yeah. So, well, today quite a lot. So Warren started off following Ben Graham and doing what Ben Graham did, and we follow what Ben Graham did. So not exactly the same, but a deep value philosophy, looking on historic numbers, on objective numbers that the company has done in the past. Warren has changed over the years, and it doesn't make him a bad person. He's clearly a very, very good fund manager and has delivered a wonderful long-term return for his clients. But he's trying to solve some problems that we don't have as investors. So he's trying to solve the problem of, well, how do you manage the amount of money that he has under management? Well, we don't have that amount of money, so we don't need to invest in the compounding businesses because we can transact in the marketplace. We can buy and sell, and that allows us to be more nimble than Warren can. We don't have an insurance regulator breathing over our shoulders, which means we don't have to worry about volatility in the same way that Warren does. So he's trying to solve for issues that we simply don't have, and therefore the answer that Warren has come to those questions isn't necessarily the right answer for us. So without an insurance regulator and without worrying about the ability to buy and sell, we were able to do what Warren used to do, which is simply buy the most attractive opportunities anywhere and then hold them till they reach fair value, sell them and move on to the next thing.
Okay, and do you have some favorite valuation metrics?
Yeah, so it's all based on historic valuations. So our favourite one for our screen is based on effectively the cyclically adjusted PE. So it's the Graham and Dodd PE, just inflation adjusted, because we love Ben Graham. So Ben Graham and Dodd PE is right up our street. We also debt adjust that valuation metric as well, so it's not just used on a PE basis, but on an enterprise value basis. And those metrics are, particularly in the non-financial space, are the ones that we focus on.
Do you use more or less the same criteria for also financials?
Well, in financials it's much more difficult because enterprise value as a concept doesn't exist. So there we still use cyclically adjusted PE, but we may also use price to book and try and understand the business's return on assets, return on equity and so on, to try and understand the leverage that's involved and whether or not a low price to book is actually attractive or not, and trying to understand the capital ratios to understand whether the low valuation is justified or actually whether it's attractive.
So last question, so you're almost 100% bottom-up investor?
Correct, yes.
Okay, thanks for the interview.
No, not at all, thank you very much.
Thanks.